On to a quick overview of Chapter 9, Checking Accounts and Banking Services. So 9.1, we're just going to talk about the basics of checking accounts, and 9.2, banking services and fees. Checking accounts are things that we should all pretty much be familiar with at this point because most of our guardians have had checking and banking accounts, and hopefully you, even at your age, have one as well. So in the book, the definition of a check is a written order to a bank to pay the amount stated to the person or business named on it. In the textbook, you would be considered the maker of the check because you are writing the written order, and then the person who you're writing the check to, or the company that you're writing the check to, is going to be the payee. So a checking account can sometimes be referred to as a demand deposit because the money may be withdrawn at any time, that is, on demand. And the cycle is a pretty important cycle to learn. So the payee cashes your check. So for example, I could write a check to, let's just say my landlord was named Mrs. Smith. If I write my check to Mrs. Smith, she is the payee. When Mrs. Smith goes to the bank to cash my check, the banks, so we're starting right on step 2 here, communicate to each other. Mrs. Smith's bank communicates with my bank, and the goal for that is, or the goal of that communication is to have my bank withdraw the money from my account and send it to the bank of Mrs. Smith. So electronic movement is done instantaneously, and so now that we are in 2018, a lot of the transfers, transactions, bills, pays, and things like that are done instantaneously within the banks. The bank then stamps the check to make sure that no one else can use it and indicates that it has cleared. The other term for it is canceled, and it gets a little confusing because canceled in most people's opinions means it didn't go through, something went wrong, it was canceled. But in the banking world, a clear or a canceled check means it's gone through the full cycle of the actual transaction and it has been cleared, meaning it can't be used again. So that's the process of an actual check. With a checking account, you have money in this account and it is being slowly deducted as you write checks or as you use an ATM card, which we'll talk about in a few slides. But if you write a check for more money than you actually have, that's considered an overdraft. The term not sufficient funds, or NC or NSF, that's a stamp that the bank has. It'll stamp the check NSF, and then it gets returned to the payee's bank account, meaning it has bounced. So the word overdraft and the word bounced are used interchangeably, although they do mean different things. Overdraft means you took too much money out of your account, and bounce means the check was unable to go through its full transaction or be cleared. You can get something called overdraft protection, and that is something that your bank will do for you as a courtesy. It sets your checking and your savings account, links them together. So if for whatever reason your records are off and you write a check for much more money that's in your account, they will borrow the money out of your savings account and put it into your checking account temporarily just to cover that particular transaction, and then they will notify you of this. If you don't have overdraft protection, there is a fee when you bounce a check, but with overdraft protection, usually it's an email or just a notification saying, hey, we had to take $50 out of one account and move it to your checking account to cover this last transaction. The book does talk about something called floating a check. It's not recommended, but what it would be is if you wrote a check and put a date in the future so that the money is deposited before the actual payee cashes that check or before that check clears. So if I get paid on the 15th of every month, I might write a check on the 13th because I need to get that check out, and so I float the check, meaning I will put the date of the 15th on the check, hoping that by the time it gets there, the money is actually in my account and it won't in fact bounce. So checking accounts are a great thing to have because they are convenient. There's a safety feature built right in. There's a lot of security that banks have with your money, and it's a built-in record-keeping system, especially now with all of the apps and programs online and it gives you straight access to banking services. So we really are big advocates of the checking account situation, even if we're not big advocates of actually using checks. Checks are a little outdated. At this point in my life, I'm probably only writing 3 to 4 checks a year, and that's fine. There are some companies that are a little bit older and would prefer the paper trail, so they ask for a check as opposed to you paying their bill online each month. But for those very rare situations where you have to write the check, this diagram should help you understand the parts of a check. And it is good to still be familiar with these parts when you receive a check as well. So this is the check number. It's numerical order in a checking book. Usually this is the name of the maker and the maker's address for record keeping purposes. The date, obviously, if you wanted to float it, it would be a date in the future. Both the numeric amount and the written amount should be the same. This is who you are writing the check to. Your signature would go here. This is the account and routing number, which the chapter talks more about. And this is the memo that would also kind of trigger your memory in case you wanted to know, what the heck did I write this check for? You could go back and look at a copy of it, and it would say in the memo line. My online app shows me a copy of every check that has been cleared, so I can kind of go back to that check and say, oh yeah, that's who I wrote it to. So technology, again, has really made checks pretty obsolete and at the same time made your record keeping of checks much better. So you would use a checking account to write checks, pay bills online, make deposits, but the last part of this particular section is when it starts talking about keeping an organized system. So although, like I said, most people are looking at their account balances and their information online, there is a lag depending on the different vendors that you use. So if you were to use your checking account, use your ATM card, or use your checks to pay for something at a store in, say, another country, or a store that has an older system or server system going on, they might not actually report it to your bank that day. It might take them 1 or 2 days. In the meantime, you're checking your app and it says that you have $300 in your account when really after the transaction at that store you really only have $200. So a checkbook register was very much used in previous years. It's a little bit outdated at this point, but I would recommend you keeping some kind of record or holding on to the receipts from the transactions you make so that you do have an accurate idea of how much is in your account so you don't overdraw it. Back in the day, you also used to do what's called a bank reconciliation, where you would make sure that your checkbook register or the document that you were using to organize all your transactions matched up with what the bank said it should. Again, these two things there are images of in the textbook to look at. They're not used anymore because of technology and apps and ways that you can track your spending quickly using technology. But it is good to know what they were used for and what their sole purpose was to keep you organized. Endorsing checks. So again, in those rare occasions where you receive one, you're going to sign the back of the check in order to let the bank know that you are who you say you are, and you are in fact the person who should be depositing this money or cashing this check. So the 3 types are blank endorsements, which is just as I described. You would sign the back and they would either then give you the cash amount for the check or put that cash amount into your account. There's something called a special endorsement, which if I had a $50 check written out to me, like my grandmother wrote me a check for my birthday for $50, but I owed you $50, I could on the back of the check sign my name and then pay to the order of your name, which means you now are the payee and you could take that check somewhere. And then thirdly, they also talk about a restrictive endorsement. And this is the one that tells the tellers, okay, at the bank, I'm going to take this money and put it right into my savings account or right into my checking account. Again, as always, you should be checking the chapters with this information so that you're sure you have a clear understanding. Types of checking accounts are listed again in the chapters. Joint would obviously be 2 or more people. Interest-bearing obviously does gather more interest than a regular checking account. And again, check the chapter for the specific descriptions. They briefly talk about banking services. What's important here is the FDIC. That's the protection plan for customers that insures their accounts up to $250,000. It's per account, so again, there's a lot of identity theft and fraud going on these days. That would be your protection. A certified check, a cashier's check, and a traveler's check are very different, including a money order. These are all things that you can get at the bank. Know the difference between the four of these. They are not the same thing, and it is important not only for chapter purposes, but for final exam purposes. Banking terms that you would be familiar with already are debit cards. Just like an ATM, a debit card is linked directly to your checking account. ATM cards could be a little different because they're usually sponsored by, like, say, Visa or MasterCard, but same thing, you go to the machine, you directly withdraw the money, it comes out immediately. Or you could swipe it like a credit card, but each transaction is money coming automatically out of your checking account. So it's like paying with cash. EFT, that's just a funds transfer, so you can move money from one account to another, or you could make a bill pay. This would be an electronic funds transfer as well. Stop payment order, if you lost your check or maybe you wrote it and it's taking a long time to be deposited and you're afraid it never made it to its payee, you could ask the bank not to honor that check. You call them and tell them to stop payment. It does cost a small fee to do that. Safe deposit box is another option that you could get as a service at a bank, and that's where you would have, it's an actual drawer in a wall that would keep certain birth certificates or important mortgage documents or other things that you wouldn't want to keep in your house, but there's a fee for that, yearly or monthly depending on the bank. There are other fees discussed in the chapter, and this is a great way to comparison shop. So I wouldn't just settle for the bank closest to your house. Although local is helpful, I would look for the ones that have the least amount of fees. Who's going to charge you for transactions, or who has the most ATM machines? Another thing to compare is who has the highest interest rates on their checking accounts. So all of that is really helpful before you make a decision on what bank you would like to open accounts with. And this is the end of Chapter 9. Again, the Unit 2 chapters are 8, 9, and 10. So we have one more to go.